Moving on to our next speaker, which is Mr. Saahil Poojara. He is an MBA in finance from the City University of New York, Zicklin School of Business. After graduating, he worked as an investment banking analyst in the mergers and acquisitions department at the Essar Group for 1 year. He then joined Bank of America Merrill Lynch as an equity advisor to high net worth clients. He worked there for 4 years. He quit his job in 2014 to start his own individual trading firm called Trinity Capital, and since then, he has been a full time futures trader and has been associated with Definedge and uses TradePoint since 2019. He will be speaking on volatility based positional futures trading system. This session will be moderated by Mr. Abhijit Phatak.
Hello everyone, welcome to this another session on in EDECNOCH 2021. Today we have with us a trader from Mumbai. His name is Saahil Poojara, and though he has been in the market for some time, he has started trading on Noiseless charts since last couple of years. And like everyone does, he tried various systems, but after that he finalized one system which he has been trading religiously for more than 1 year now, and he has got excellent results. So without wasting any time, let me welcome Sahil.
Thanks a lot, sir, for having me on this platform, and thank you very much to Definedge Solutions. It's a real pleasure and a huge honor to be here. So thanks a lot for having me.
Yeah, so before we start your actual presentation, if you can just outline your journey in the market, because that is what everyone is fascinated about. I mean, whenever someone starts doing well, what he has gone through before that, that is also extremely important, because every single person goes through that, and everyone has a different story to tell. So in fact, even I am always interested in knowing stories of whoever I meet. So if you can just outline the journey part.
Sure, sir, I'll do that. So I think it goes back all the way to 2007. I was living in New York City, and I had gone there to study marketing. And but I got aware of a bull market going on at that time in the world markets, specifically the US markets, because I was there and everyone was talking about it. And it just got me very fascinated, and I started reading more about financial markets. And I, in fact, ended up changing my major from marketing to finance after reading up on finance. And I don't know, just that bull market fever got me interested. And so that was where that seed was planted in my head of that I wanted to do something in the financial field, and specifically to do with financial markets. So in fact, that was 2007, around August or September. And then in a few months, as you know, we had the 2008 financial crisis and a big fall. And I still remember that day clearly. Me and a few fellow students, we were in fact under the Lehman Brothers building the day it was allowed to fail. And we were watching the scene unfold. We were watching all these employees coming out with their boxes. We were watching the media frenzy outside. And we overheard a few traders talk about how they made a killing in shorting the bank stocks. And I was absolutely fascinated by that, okay, things are falling apart, but these people are still making money. So that shorting aspect in the market actually got me very excited and more interested in financial markets. And that's how I think I gravitated to futures, because I knew that in India, if you want to go long and short both, you need to use futures. So this all interest started from there, and watching all this unfold right in front of my eyes. And
so that time you were not.
What happened?
That time you were not trading, right?
No, I was not trading. I had never bought a single share in my life. I had no idea even how to execute a trade. I was just doing my MBA in finance. And but unfortunately, what happened was that in 2009, as we all know, there were no jobs the world over. The financial sector was badly broken everywhere. And so I did not get any job in the US. In fact, it was next to impossible for non-US citizens to find work at that time. So in 2009, I came back to Bombay, and even here the financial sector was broken. So I ended up getting a job as an investment banking analyst in mergers and acquisitions at the Essar Group. So where I was responsible for identifying targets to acquire for them in the coal mining sector. So I was looking at companies and valuing companies in Australia, Indonesia, Malaysia, where they have all these coal mining resources and coal mines. So my job was to sit all day and crunch financial models and sit in front of an Excel sheet, which I did for a year. But honestly I found it very boring. So
More of a fundamental analysis, right?
yeah, it was more of a fundamental job where I was making financial models, and I in fact ended up going to the Essar Group's power plants and steel plants to understand the whole process in Gujarat and Hazira, and I spent some time over there, and then came back to Bombay and started this stint. I did that for about a year, but the thing about financial markets never left me, and I know somehow I wanted to be associated with them. I just didn't know in what capacity. And then I ended up getting an interview and a job with Bank of America Merrill Lynch at that time in about 2010, where I joined them as a financial advisor. So I did a job for 6 months as a financial advisor, and after that they saw that I had a inclination and a liking towards equities and some knowledge towards equities. So luckily they put me on the derivative desk under the head of derivatives. And I remember that my boss at the time, in the first couple of days, he asked me to come to his desk, and he opened his Reuters terminal and he showed me a candlestick chart, a daily chart. And that was the first time I saw a chart. And he told me that, if you need to excel at this job and make clients trade, then you need to know technicals. And I saw this and I was completely mesmerized. I know what are these pictures and charts, I mean, it got me really very interested and passionate. So that's the time, I think around 2010, 2011, I started going very deeply into charts, reading books, doing Google searches, and just getting my hands on anything I could, and, staying awake late at nights and just reading about things to learn more about technicals. And so this went on, and I was working there for about 4 years, and simultaneously, as time went by, I was more and more convinced that I can do this for myself. I kept telling myself I can do this for myself. I can make money for myself. I don't want to sit and work here. So I need to figure out a way how to I come up with a system which helps me do this and achieve this goal. So for a couple of years, I kept working on systems and kept backtesting stuff and on all the large caps and on the Nifty. And then in 2014, finally, after 6 months of deliberating and thinking whether I should quit or not, I finally had the courage of taking that step, and I quit. And that I remember that was a Friday, and on the following Monday morning, I started trading because I already set up a company. I had already set up a system, which in hindsight was not a great system, but at that time, I thought it was great, and the backtesting results, as usual, show good results. So, and what happened was, luckily or unluckily, as you can call it, in Feb 2014, the day I started, within a day or two, the market started a massive rally because the markets were expecting Narendra Modi to come into power. So they started a huge rally, and believe it or not, in the next 3.5 months, I doubled my account because I was trading futures, and I at the peak I made about 105 to 110% because I was taking very big risks. I had 25 to 30 positions open. At that time, you could do that also because the margins required were very low at that time, much lower than what they are today. Plus, if you remember, the lot sizes were just 2.5 lakhs. Today they are like 5 to 7 lakhs and higher. So it's not as easy as it was back then. So I thought, I was really flying high. I thought I'm going to retire within 5 years
I think
after
Nifty
doing
was
that.
what? Nifty was 5,000 that time?
I think it had broken. No, it was sometime somewhere above 7 or 8,000, if I'm not mistaken. In 2010, it
Yeah,
had
sorry.
broken a
Yeah,
top of
yeah.
6,000.
Yeah, in 2014, after the Delhi elections, it crossed the previous top of 6357, I remember. And then it came down and then
Exactly.
again started the rally. Yeah.
Yeah, so I was flying high. I thought I'll retire in 5, 6 years and I'll travel the world, and all these thoughts start coming into my head because I'm like, this is so easy. You're making money in a one-way market. I'm like, I don't know why people find this so tough, but then reality hit, and I remember after those 3.5, 4 months, when the market started correcting, that first day I had 30 to 35 positions open, and that first day the mid cap index dropped 4.5 to 5% in one day. So within those 3 hours in the afternoon, I remember I had 32 stop losses hit in a row. And in those 3 to 4 hours, I lost 50% of my profits, what I had made in the past 3 to 4 months within a few hours. So I was completely in a state of shock.
But at least you had the stop losses in place and in the system.
Yeah, so the thing is, I had stop losses in place. I never, from the beginning, I had drilled it into my mind that, whenever you take a trade, stop loss should be stayed in the system. But I never put a cap on the amount of positions I should take. I never thought of that. So the leverage, I think at that time I had gone up to 4 or 5:1. So I was hugely leveraged, and that came crashing down. And in one day, I lost all that money. And after that, believe it or not, for next 6 months I went to office every day, but I could not get myself to take a trade for 6 full months. I would go every day and just sit there. My system would give signals, it would give alerts. I couldn't act. I would freeze. And even the few times when I took a trade, I would keep staring at the mark to market. And anytime it went even a little bit against me, I would square off the trade. And this kept happening. So it was a very, very actually painful period emotionally and mentally. And then I started, in fact, I stopped trading for a few months in the middle of all this, after all this started happening. And I then started figuring out, okay, what do I do? I started looking at different kind of systems, different kind of methods, more into risk management, more into portfolio management. Okay, how do I, avoid this from happening again? Okay, so I tried many different things. I tried 15-minute charts trading. I tried daily. I tried 75 minutes. I tried Elliott Wave. I even bought expensive softwares where with ready-made buy and sell signals.
Okay.
So yeah, so I tried all this stuff, and there were phases where I made money. It's not like I was losing money all the time. There were phases where I made money. I just could never keep it. I kept giving it back. And if I had not been conservative, or I had not been like risk averse at that time, I would have not survived. It's just that I was so risk averse after that incident that I didn't get hurt that badly. It's just that I didn't make meaningful money for a long time. So, and then I realized that it's no different for a lot of people, and the learning curve in this market is very steep for most of us. And then in 2018, I remember clearly I was just scrolling mindlessly through Twitter, and I came across tweets of Noiseless charts and of Definedge and of TradePoint. And I'm like, okay, these charts look so neat. There's no sideways, there's no choppiness, there's nothing there. I mean, looks like these charts only make money, you know. So, uh, so I started going. Instead of buying the software, I first bought Prashant Sir's book, which again I found on Twitter. I read his book. I got some more knowledge. This took about a few months, and I continued trading a system I was trading, but I was making a little money. It was nothing meaningful, and but I had my risk management in place, so I was not getting hurt anymore. I was not getting badly hurt. I was kind of stable, but not consistently profitable yet. And I still remember, like I was telling you earlier, one day I came across a tweet from Mr. Mangesh Joglekar. I remember it very clearly. It was a Renko chart, and it had the Must system on it, the Must trading cloud, and it was a Bank Nifty. And that day the Bank Nifty had fallen 1,000 points, so it was another short trade. So I got so excited seeing that picture that in the next 1 or 2 days I called up Definedge and I purchased TradePoint. And then again another steep curve started, because then I started figuring it out. I took some I took your training sessions which are offered, and for the first few months I was again struggling, because I was trying to trade everything. I was trying to trade 1 minute, I was trying to trade daily, I was trying to trade different patterns. Whatever the newsletter would give out in that week, I would try that out, like flavor of the month. So again, the problem was there was not any consistency in what I was doing. So money would come, money would go, money would come, money would go again, that same vicious cycle, till I came across something, till I understood that, okay, what is suiting my psyche, what is suiting my temperament, and till I came and focused upon one thing. And I started slowly doing that, and I started actually shedding the fat. So from my business, I started cutting out like stuff to do. So then I realized that less is more, and I started just focusing on very few things, which as as we go ahead, I'll show that got even lesser and lesser and lesser. Then it came down to just one or two things, and that's like been a kind of a roller coaster journey. But happy to say that of late and of recent past, I've been consistently profitable, and have peace of mind now, and it's been a steep curve, but it's been also rewarding in many ways.
It's like after getting exposed to the financial market, after 10 years, you found your sweet spot.
Yeah, because yeah, from the time it started and you started learning, and before even trading, if you count all that time, yes, it was around 10 years till the whole journey started.
Yeah.
And after trading, the stability came in after the first, I think, 4 or 5 years.
Yeah. No, why I mentioned it was it's a big lesson to a lot of people who think that they can become successful only in a few months or maybe 1 year or 2 years. Of course, it is possible. I'm not saying it is not possible, but it can take even 10 years. That is what I wanted to highlight.
No, it definitely can take its time, because the main problem here is that you can get the best of the systems. There are thousands of ways to make money. All of them work, but it's your psychology which is the problem. Until that doesn't get corrected, it's very tough to be consistent, and that unfortunately takes some time, beating, and experience. To get somewhere where you understand that okay, it's
Yeah,
all about the psychology at the end of the day.
which means basically identifying what suits your temperament, your pocket size, and your psyche, and then adapting to it, and then developing it, and maybe modifying it. But identifying what suits you, that is the key.
I think that is the main thing, because as if you remember, like Prashant San, one of the videos, had spoken about the turtles and Richard Dennis, and how Richard Dennis had said that even if he had published his system in the newspapers, there would be hardly any people who could have followed religiously, because it just could not suit that mindset.
Right.
So I think at the end of the day, it's all about that.
Yeah. So that was a fascinating journey, definitely. And now coming to the system which you have finally started trading successfully over the last 1 year. So can you take us through that system and give some examples also?
Sure, sure. So I'll take you through the system.
Yeah.
So you can see my screen, right, sir?
Yes.
Okay, so it's basically a volatility-based positional futures trading system, and it's a very minimalistic trading system. So it's embarrassingly simple. It has very, very few parameters to it, and I now in hindsight, I think less is more and the simpler the better. So the universe which we'll be using is the NSE futures universe, which I think up to a few days back at about 160 stocks, and as you know, in the last couple of days they added 10 stocks and then 8 more stocks. So I guess by October of 2021, we'll be having about 180 stocks in that universe. So
Yeah.
that would be our universe. Uh, the index I use for the relative strength comparison would be the Nifty 50, because we're trading a futures universe which is comprised of mainly large caps and the larger mid caps. So we're not going to use the Nifty 500 nor the mid cap or small cap index or nothing like that. Nifty 50 for RS comparison is more than enough. So we'll keep it simple. It's a continuation breakout system. So 80 to 90% of the time, the system is trading only established trends. And
Just 1 minute. Sahil, 1 minute. You know what is RS, I know what is RS, but in case someone doesn't know what is RS, so if you can explain that. I mean, for us, it's like a second. So if you can just explain what is
No, for
RS.
sure. So relative strength is basically where we are taking two instruments and comparing them to each other. We are pitting two instruments against each other. So relative strength, basically we use a ratio. Now a ratio is nothing but a numerator and a denominator. So in our case, in this approach, the numerator will be the stock and the denominator always will be the Nifty 50. So what we are doing is we are taking the stock and we're dividing it by Nifty 50 to get a ratio of the stock strength versus the Nifty. So
Okay.
if the ratio chart is moving upwards, then we can say that the stock is strong and it is outperforming the Nifty 50 on a relative strength basis. And
Right.
if the ratio chart is moving downwards in a downtrend versus the Nifty 50, we can say that it is underperforming the Nifty 50. And as we go ahead, I will explain that further with examples about our relative strength. Should I move ahead, sir?
Yeah, sure.
Okay. So as I was saying, it's a continuation breakout system. So mainly it trades established trends. It very rarely will you get a change of trend or a reversal trade in this system. And as we go ahead and look into the dynamics of the system, you'll understand why. So I use point and figure charts, and the box size and time frame I use are 0.25% and daily time frame. And this is for both the price chart for analyzing and picking stocks to trade, and also for the relative strength chart versus Nifty 50. Both will be using this. So we're keeping it very simple. We're just using one time frame and one box size.
So the RS chart
It's a
also is
direct,
on 0.25%?
yes. So the price chart and the RS chart both will be looking at the same PNF chart, the same box size, which is 0.25%, and the same time frame, which is daily, both. So
Okay.
there's no confusion at all. We're not looking at multiple time frames while analyzing the charts or anything like that. We're just sticking to one time frame. And it's a directional system, so it's a long and short trading system. So we'll be going long the strong stocks and we'll be going short whenever we get weak stocks which give us setup. And as I said, it's very minimalistic, it's very simple. There are only two indicators that I've used mainly in this system. The first is 45-degree trend lines, which we'll be basing our entries on. And the second is the 14-column average to range, which we'll be using as a volatility measure, and also we'll be using that to manage risk. These are just the few parameters which the entire system is based on. So to start off with, we'll be taking a top-down approach where we first look at the sector. If you want to go long, then we want to look at strong sectors, which are again outperforming the Nifty on a relative strength basis, which we just went into in the earlier slide. And within those sectors, we want to look at relatively strong stocks which are giving our setup. So it's a top-down approach, and we'll start with the sector. And let's just first come to how we'll pick sectors and just a little analysis on the strengths and weaknesses of that approach, which I use. So I'll just move on. So this is a sector matrix which you can get in the TradePoint desktop software. You go to matrix. Under the matrix tab, there'll be something called a sector matrix. You click on that and you click on scan. You will get a table like this. Now what I do is I sort this by the RS ranking score column, which I'll explain in a minute. And I must credit this technique or this method to KK Sir's Friday webinars, which is where I learned this. And it actually agreed with me a lot and made a lot of sense to me. So I've been using this consistently. And also this table has 4 time frames or 4 box sizes. So it works well for someone who's using it on a positional basis. So why we are sorting it by RS ranking score is nothing but a measure of momentum, right? So this table is telling you which sectors are outperforming the Nifty 50 and which are underperforming the Nifty 50. So it's taking each sector and putting it against the Nifty 50 again on a relative strength basis. And so the ranking score basically takes the more the number of X's on a sector chart versus the Nifty, the more the momentum will be on across the board. And it takes into consideration all 4 time box sizes, which is 0.25, 1, 2, and 3%. So the more number of X's, the more momentum, the more higher the score will be for the sector. So in this example, as you can see, this is the Nifty 50 right here, which has a score of 0. So whichever sectors have a positive ranking score, which will be above that, are the outperformers, and whichever the sectors have a negative ranking score are the underperformers. Now, mind you, the sectors are not necessarily weak. It's just that they are underperforming the Nifty at that point in time. And the ones which are above Nifty are outperforming the Nifty at that point in time. So let's take a look at a little bit more into the sector matrix and why we're using it. So I wouldn't there are pros and cons to it. Basically, it's a trade-off when you're using something just as in life and in markets and in trading. When you make a decision, there's always a give and take, there's always a trade-off, and there's always advantages or disadvantages to your decision. For example, if you try to get an early entry, then you will have more false breakouts. If you try to make your entry later, then it's going to affect your risk reward. So there are always trade-offs in the markets and in trading. So let's take a look at some of the trade-offs over here. So the pros for this approach are that it first of all gives a multi-time frame view. So we are straight away starting the first step of our process with a multi-time frame analysis, which we pointed out earlier. There are 4 different box sizes. These box sizes equate to daily, weekly, bi-weekly, and monthly if you want to put a time element to it, and like how we do in candlesticks or bar charts. So it gives a multi-time frame view. So we are starting with a sector which is strong across the board, and maybe that can give us some slight edge and increase the probability of catching good trades. Also, it gives a very stable picture. So this table doesn't move every day. It doesn't change every day unless something significant happens in that sector. It moves slowly. It moves over time. It moves over a few days to a couple of weeks. So, sectors which are consistently outperforming, we'll keep getting them as outperformers on our radar, and we'll keep catching continuation trades within that sector with superior RR as long as the sector is outperforming. So, for example, a lot of people know that the metal or the commodity sector has been outperformer for the last few months consecutively and consistently. So, you're going to keep catching setups from those sectors because they've been on top of that table ever since. So, this really helps you in catching some good trades. But as I mentioned earlier, that there are always trade-offs and disadvantages to using a certain approach. And one of the disadvantages of this approach is that we can miss some good opportunities as we are not using a bottom-up stock picking approach. So these are some of the stocks which came to mind, like Balakrishna Industries from loosely is from the auto sector. Now the auto sector has been an underperformer for quite a long time. But same is the case with Godrej CP from FMCG or PEL from the financial services sector. According to this table, none of these sectors at any point in time in the last few months have been outperformers. But individual stocks from each sector obviously have done very well, such as these names. And of course, there are many more. So you can miss many good opportunities if you're doing a top-down approach. And of course, there's nothing right and wrong. There are a lot of people who are very good bottom-up stock pickers, and that approach maybe would suit them better. But this is just one of the cons of using this approach. And also, we will not be catching too many reversal trades or change of trend setups, which could give early trades and give huge moves. Therefore, but to illustrate this point, I'll just go back to the earlier slide. So you see at the bottom of this table, auto, media, consumption, FMCG, they're all underperformers since a while. Now, if these have to start outperforming the Nifty, they have to start breaking out. Their stocks have to start moving up significantly and outperforming Nifty for that to start moving up. So that's not going to happen overnight up on this table. It's going to take time. So by the time it comes on our radar, the change of trend setups most of the time are over. The leaders from those sectors have already moved up. And by the time they come on our radar, we are going to be looking for continuation setups. So that's why I'm saying that this approach, what I use, is more of a continuation setup. So any other questions, or can I move on?
No, you can proceed.
Okay. All right. See, this is one of my favorite quotes actually from Mark Minervini. The birth of greatness occurs when one holds a vision and a dream independent of the current environment. So this is for all those traders, who maybe right now are struggling to be consistent, are struggling to find some system that suits them, or struggling to find an approach in the market. I would just tell them to stick to it. Stick to the belief, and just keep working hard. And also, when you're learning and when you're going through this steep learning curve, be conservative. Don't try to hit home runs. Be conservative. Protect your capital. That's number one. And this is actually a very inspirational book. It's more on trading psychology. It's by, I'm sure most people have heard of Mark Minervini. I think he's one of the modern day greats of our time. And the book is The Mindset Secrets for Winning. So I would urge you to read this book. It's quite an inspirational read. So coming to relative strength, as we discussed earlier, if we want to go long, or if we want to, buy stocks, and we want to bet on someone like this guy who's strong, and weak stocks, we want to short stocks that can easily be bullied, or avoid this guy. Or if you want to short weak stocks around because they have no strength in them against the Nifty. So that's basically on a simple note what relative strength is. We're just trying to find strong stocks which are outperforming the index, because we want to outperform the market and we want the equity curve to look more stable. And this is one of the tools which really helps to do that. So coming to relative strength, as we discussed earlier, we'll be using the same chart and the same box size and same time frame, like 0.25% daily on a point and figure chart. And I'm just going to discuss some of the conditions which are acceptable to me and which I look for when I get a setup of on a stock or price chart. What should the relative strength look like? So acceptable conditions for me are, number one is a double top buy above the 10 column moving average. So I know I've put a triple column moving average on this chart because it's just out of habit. That's how I look at charts since a while. But it is not needed. You can keep it simple by just putting a single moving average on the chart. A 10 column single moving average is more than enough to analyze the price or the RS charts. The second condition is a low pull above 10 column moving average. And third condition would be a double top buy above the moving average plus a retracement, but preferably it should not be a double bottom sell, which has retraced deep. So here, first example, you can see Tata Steel versus the Nifty, and you can see the Tata Steel chart is in a very nice uptrend. And here, after giving a small correction and a double bottom sell, you can see a low pole form. So that could be indicating that Tata Steel could be reversing. So when you get a breakout on your price chart, if the relative strength has something like this, it is acceptable, and you can go ahead and take a chance on the trade. Then let's take a look at another example. This is an example of AU Bank versus the Nifty 50. In fact, this is one of the strongest examples of relative strength you can come across, where the the chart is in a column of X and it is in a double top buy and it's above the 10 column moving average. So these are so when your stock gives a breakout setup, these are some things which you should not ignore, and these are very high probability situations according to the relative strength charts. So this is another example.
Any conditions on the
This is
ATR parameter, or I mean, what do you look in that?
ATR is not used at all when we are looking at relative strength. ATR is only used to manage risk when we come to the trading setup. Right now, we're just looking at these few conditions on the price chart itself, only on price.
Okay.
Yeah. So coming to Bharat Forge, you can see there's a double top buy here and there's a small retracement. There's no double bottom sell. And it's above the 10 column moving average. So this is also an acceptable condition. And also here you can see there's a 100% pole, which is a very strong reversal pattern in point and figure charts, one of the strongest in fact, and it is also a big anchor column. So when you have something like this plus a cluster of different patterns on your relative strength chart, also that also helps, and that also could mean that the stock is quite strong and could move higher. And the final example I want to share is of Havells, RS chart of Havells versus Nifty 50. Although you can see there's a small double bottom sell right here where the cursor is pointing, but if you see the overall picture, there's a huge anchor column breakout, and then there's a side correction consolidation. This is like an ABC pattern for people who are familiar with PNF patterns. It's a very, very strong pattern, and so this is basically just telling you that after a big breakout, this is just taking a breather, taking some rest, and the RS chart could break out higher. So although there's a small DBS or a double bottom sell, this is also a nice and high probability situation on the RS chart, which you should consider if you get your trading setup on this. So these are just the few conditions which I look for on the RS charts. And now I'll come to the trading setup and rules.
Yeah.
As mentioned earlier, it's a very, very simple trading setup, and there are very few rules to it. But this is how the chart looks like. This is just two things as I mentioned. First, there's 45-degree trend lines, and there's a 14.
Just one minute, Saahil. All
Yeah.
the previous charts which you showed were all RS charts of individual stocks with Nifty, right? Yeah. And now that you have identified which stocks are outperforming Nifty, now you will go to the individual chart to see, to look for an entry.
Yes, you can do that also, or you can, if you want, you can go through the stock charts, and then wherever you're getting a setup, you can go and check the relative strength to filter whether you want to take the trade or not. So both ways of doing it is okay. So coming to the trading setup and rules, this is what as I was saying, this is what the chart looks like. Again, I'll repeat, I have kept a triple moving average here, but it's not required. You only require a single column, 10 column moving average is more than enough. And you have the trend lines, and you have your 14 column ATR, which you will now use on the price chart. You will not use it like EP, so you asked for the RS charts, but you will now use it for the trading setup. And let's just take a look at the rules quickly before we look at some examples and move further into this. So trade execution rules are: entry is a simple breakout above the 45-degree trend line on a closing basis. Your initial stop loss is, so whatever entry price is, you subtract the 14 column ATR value of that column at that time. That would be your initial stop loss. So if I give you an example, suppose your entry price is 1450 and your 14 column ATR value is 50. So your stop loss is, let's say, 50 rupees. So your initial stop loss will be 1450 minus 50, which is 1400. So that's your first is your entry, which is the trend line breakout. Then is your initial stop loss where you're subtracting the ATR value at that time in that column from the entry price. And the third is the target, which is a 2:1 reward to risk ratio. Now again, this is something I use more often, 2:1, but it's not some magic number. You can go up to 2.5:1, you can go up to 3:1, you can even go lower if you want quicker trades up to 1.6 or 1.5, but I would suggest that don't go below 1.5 because then that starts putting pressure on your win rate. The lower you go into risk reward, the lower you go on reward to risk ratio, higher your win rate has to be, and that puts a different kind of pressure on your system. And you don't want to go too low. So, for example, if I'm consistently taking profits or attempting to take profits at 2:1 reward to risk ratio, then to break even, I just need a win rate of about 33 to 35%. Which takes a lot of the pressure of the win rate.
Yeah.
So at a, sorry, did you say something?
No.
Okay. So that's the target which I've been using. And for example, 50 rupees is your stop loss. So you would multiply that by 2. So your target should be about 100 rupee profit. So from your entry, you add that 1450 plus 100. So your target is 1550. Okay.
So this is just an arithmetic target, is it? You don't go by the count or just trailing or
no.
nothing like that.
I use, we'll come to trailing, but I use an arithmetic target. I don't go for the counts. And one of the reasons for that is sometimes the counts are very far. And to hold, look, it's to hold futures on a positional basis for that long, sometimes it gets difficult mentally.
Yeah.
So I prefer to use a arithmetic target, but there's nothing wrong in using counts or vertical counts also in this. It's just that I have not done it myself.
Just to clarify that again, so let's say you have taken here entry at 1450 with a stop loss of 1400 and you book at
Right.
1550, and in case it just keeps on going up to 1600, 1700, you are not bothered. You won't look for a re-entry.
No, see, I'm not bothered at all. That 2:1 is my sweet spot for now, and that's why I'll exit. And although I am testing riding trades, but I haven't done it, and I don't have enough data to comment on it. So as of now, if you ask me, after that, whatever happens to the stock, I don't care where it goes.
Okay. So you look for another stock after that.
Yeah, I mean, trades come like taxis and buses. So I just keep looking for the next trading opportunity.
Right.
Yeah. So this is just the initial part of the. So we have an entry, we have an initial stop loss, and we have a target. Now let's take a look at a picture example. This is a example of Wipro, a trade I took some time back, and you can clearly see here, sir, that Wipro has broken out and closed above the 45-degree trend line. Is the image clear to you, sir?
Yeah, I can.
Okay. So you can see that Wipro has closed above the 45-degree trend line and has completed the breakout. So your entry, you can see here the price is around 550. So let's say we enter around 550. The ATR, the 14 column ATR for this column is around 20. So our first rule is that our entry is 550. We are subtracting 20 rupees from the price and our stop loss is 530, which approximately translates to around a 4% stop loss. So since 20 rupees is our initial stop loss, we'll multiply that by 2 and we'll get a target of 40 rupees. So 550 plus 40. So our target for this trade would be 590. So this is the basic setup. All right. This is the basic setup with the basic rules. And now we'll just move on to the trailing stop loss. So there are two types of trailing stop losses, and I'll explain why. So the first trailing stop loss is, let's say that if the trend continues in the same column after the breakout, let's say you entered on a breakout and the trend has continued in the same column. So at that time, the trailing stop loss would be whatever the closing price is of that day. You would subtract the 14 column ATR value of that column at that time. But mind you, I just want to point out that the closing price has to be in your favor. It shouldn't be that I've gone long and tomorrow the price is close 2% against me and I can't trail the stop loss then. It has to be closing in my favor. If it doesn't, then I just keep the stop loss to where it is in the previous day.
So your entry is at your entry is at 3:25 p.m. or after the market opens the next day?
See, there are 2 ways to do it now. Either you can take it, it's not the next day definitely. Either you can take it around after 3 o'clock, and you can pay the price that sometimes if it breaks out in the middle of the day and it goes too far, then you can't take that breakout and you have to let go of that trade. Or what you can do is you can take it even if it comes at 11 in the morning, but then you're paying in slippages if it closes back down below the breakout level at around 315. So there's again another trade-off to doing this. What I do is I take it even if it comes in the middle of the day, I take the breakout, and then if slippages happen, which they do at times, I will take the slippages and move on. But I definitely don't wait for the next day.
So only let's say you have got a breakout somewhere at 11 o'clock, as you said, but at 3:30
Right.
it is not closing above the trend line, you will get out.
I will get out and I'll take whatever slippage is it. If I entered at like 1900 and the breakout was 1900 and it's closing at 1870, then I'll take a 30 rupee slippage and I'll get out.
No, why I asked is a lot of people
But
have this habit of saying, "ठीक है मैं कल देखता हूँ," that kind of thing. So you don't believe that.
but no,
Yeah.
I don't believe that because the best ones don't wait for you. The best trades, I'm telling you, I've seen this over the years. The best trades don't wait for you. They will break out right out of the blocks and they'll keep moving up. So the thing is, there's nothing wrong even if doing the trade at 315, 330. But at that time now, if your entry was at 1900 and it's already at 1960, then that's too far to then take that breakout. So you have to let it go. So in both ways, you have a cost incurred, either slippages or either late entry. So it really is a subjective question, and at the end of the day, whatever the person's psyche is, or risk tolerance is, or whatever his mind frame is, he'll have to decide based upon that.
So in this specific example which we talked about, let's say the breakout is at 1900, that 1900 is crossed at 11 a.m., but it closes at 1870. So you exit.
Yeah.
And what
Yeah.
if it gaps up above 1900? Like say, do you again look for a re-entry or what do you do?
I mean, if it gaps up way too much and it's unaffordable based on from where the breakout is, then I'll just let it go.
Okay.
You have to let it go then.
Yeah, fine.
Because you don't want to chase. Because what happens is the more you chase it, the higher the chance of you facing a retracement, which can come and take a stop loss out.
Correct.
Because your stop loss although remains the same because of ATR, it just becomes that much higher.
Yeah, I understand. Yeah.
Right. So the more the stock moves and then you're getting in, so the more the chance of a reaction to just shake out the weak hands, and in that you get shaken out. So I feel that we should not chase the trade. We should just let it go.
Yeah. Okay. Go ahead.
Should I move on, sir?
Yeah. Yeah.
Okay.
Sure.
So this is the first trailing stop loss. So let's see if it's going in the same column. All right. So the closing price minus the 14 column ATR value at that time would be the trailing stop loss, provided it's closing in your favor. If you're short and if it's closing up against you, then of course you cannot trail the stop loss. If you're short and it's closing 1% or 2% lower, then of course by all means trail your stop loss. And we'll take a look at an example first for this method. So let's say your closing price is 620. Your ATR value is 30. So your trailing stop loss for that day, for the next day, would be 590. And if you look at an example in a picture, let's say this is LNT. Let's say you entered around here at the breakout. You entered here the breakout, and in the next couple of days, this column X has grown taller and is going in your favor. So what you're going to do is, let's say the closing price is 1668 and it's closed up 2.7%. You're going to take the closing price and you're going to subtract the ATR, which is around 41 here. You're going to subtract it from the closing price, and that's going to be a trailing stop loss for the next day. So in this case, it would come out to around 1627 or something like that. But keep in mind that this is a low ATR environment, so the stop loss is not that wide. But this is not always the case. Sometimes the ATR environment, the volatility environment is quite high, so the stop losses also can be a little wide. So it depends on what the situation or the environment in the market or that particular stock is. But for this type of trading stop loss, we'll just simply subtract it from the closing price.
Do you have any filter about? I mean, stop loss is. I understood what is the stop loss, but do you have any filter to decide in terms of rupees per stop loss? I mean, rupees per loss.
No, I didn't. Sorry, could you reframe the question, sir?
Let's say your stop loss is 50 points,
Right.
based on the ATR subtraction, but it is going to
Okay.
something like 35,000 rupees. So do you have a filter
Yeah, so
limit on the amount you're going to use?
yeah, so actually I'm coming to that at a later slide.
Okay, fine.
Yeah, I'll address that point at just in a couple of slides. So I'm just going to move on to the next trailing stop loss method, which is after a follow through. For people who are not familiar with what a follow through is, it's nothing but if there is if you've taken an entry on a breakout, if there's a retracement after the breakout followed by a double top buy, so a follow through buy after you've taken the trade, then the trailing stop loss is nothing but a simple double bottom sell or a high pole. And I'll illustrate the reason and the method through an example. So let's say AU Bank. This is a breakout over here. So you entered over here. You went long above this 45 degree trend line, and the trade kept going in your favor in this current column. So at that time, you kept trailing it with the ATR. But then there was a retracement and another further breakout. So at that time, what we want is our trade is well in profit. We want to protect our profit. So we will try to make the trading stop loss a little faster by moving to a double bottom sell or a high pole. So the trailing stop loss will come below this column of O. And another reason is that when there's a very high ATR environment, sometimes even after a follow through, if you were to use the ATR to calculate a stop loss, it would end up coming way below a double bottom sell.
Right.
Now we don't want a stop loss which is that far. That's why we are shifting our speed and our method of stop loss to a double bottom sell or a high pole and trailing it that way. Now, someone who is using these charts a little differently and wants to ride a trend and is using the moving average as a stop loss, then they don't need to do that. Then they can keep riding it. But for someone who wants to take quick profits and who doesn't want to stay in trade too long, then they should use a double bottom sell or a high pole. So these
Okay.
are the two methods to create stop losses. So far so good, sir.
Yeah. Go ahead.
Fine. Now let's come to some of the advantages of using ATR or using volatility. First of all, we know that markets move from in cycles from contraction to expansion and vice versa. So we can take advantage of this approach. But so when there's a low ATR, we can take a bigger position size automatically because the stop loss is smaller. And a smaller position size when the ATR is high because the stop loss is bigger, right? So this is coming to your question, sir, which you asked a couple of slides ago, that we can ignore unaffordable trades when ATR is at extreme highs.
Yeah, right.
So it's again, it's subjective. For some people, 4-5% stop loss may be too much. For some people, 7-8% stop loss too much. But I would say, if your stop loss is close to 9 and 10% in futures, that is a little bit high according to my liking, for two reasons. One is that the loss per lot gets very high. Second is that means that if your stop loss is 10%, that means your stock has to move 15 to 20% if your risk reward is between 1.5 and 2. Now, the probability of that happening in a future large stock, 15 to 20%, may not that happen that swiftly and that fast and that often. So basically, you're not getting odds on your money. You want odds on your money. You want a favorable risk reward ratio. So if your ATR is at extreme, then your stop loss is unaffordable in terms of percentage. I would ignore the trade.
Okay, fine.
So in those scenarios, yeah, you can ignore the trades. And what is another advantage is that this becomes very mechanical, right? Your exposure to the market gets automatically regulated due to using ATR or using this approach. You don't have to sit and second guess. Okay, now how much market's gone up so much? Should I reduce the position size? Market's fallen so much. What should I do? How much should I take? All these discretionary points get taken out of the picture, and it becomes way more mechanical. And for me as an individual, it works much better when I take out discretion, and because it reduces second guessing, it reduces stress. I can just concentrate on following the process because all of this stuff is taken care of by a simple formula. So these are just some of the advantages of using this approach of ATR or volatility, especially in future stocks. See, the thing is, in cash stocks, you don't need to maybe do this because you can keep a stop loss at the swing low and take a smaller quantity.
Right.
In cash, you can regulate the position size however you want. So in cash, you may not need to use all this, but in futures, because of a fixed lot size and because the margins are so high and because the lot size are have gotten so big over the years, this approach can help us trade futures in a more affordable manner.
Yeah.
Yeah. So moving on, this is a really important topic, which is also very close to my heart. So unless you want your account to look like this, going down like a roller coaster, uh, you need to give a lot of importance to risk management. And so I'll point out one thing. After the first few months where I shared my journey and had those struggles, after that, I think from that day onwards in 2014 or 15 till today, I don't think I've ever broken a risk management rule, not even for one trade. The big losses I've had have only been through gap ups or gap downs where were not in my control. But the only reason I've survived a few tough years and I've never blown up an account or never had a losing year is because of risk management. I may have had many break-even years or very small profit years, which are meaningless in terms of earning money, but I never got hurt very badly because I followed risk management very religiously. So
Yeah.
I'll just go a little deeper into this topic. Something called a very simple concept, something called dynamic position sizing. So let's say we are taking 1% risk per trade of our total capital. Okay, now again, just before we move on into this, I just want to make something clear. This 1% is not a magic number. It could be for more conservative traders, it could be 0.5%, 0.75%. For more aggressive traders, it could be like 1.5 or 2%. But I would suggest from experience that not to go above 2%, because just think of it this way: if you have 5-7 losses in a row, which is actually not if, it's when you have 5-7 losses in a row, it's inevitable. Your drawdown, if you're risking 2% per trade, could be close to 15%. So you have to see your psyche, your temperament, and what your risk tolerance, and also how big or small of a drawdown can you handle, and based on that, choose this number. But more or less, it should be in this range. So let's take an example with 1% risk per trade of total capital. Let's say you have a account which you have a crore of capital to trade the market. Now we'll take 1 crore multiplied by 1%, so it comes to rupees 1 lakh. So basically per trade, we are not going to risk more than 1 lakh based on our total capital. Okay, so the example would be entry price is 1450, ATR value is 40. So we already know now from the rules I've discussed earlier that 40 rupees is our stop loss. Okay, so lot size is 850, for example. So our lot size is 850 times 40 rupees stop loss. So our loss per lot is 34,000 rupees. Now we've decided to take only 1 lakh risk per trade. So that comes to 3 lots maximum for that particular trade, because we can't lose more than 1 lakh. So here the loss comes to 92,000. We can't go above that. So we'll stick to our rules and we'll take only 3 lots for that trade. And as discussed earlier, the stop loss would be 1450 minus 40, which would be 1410. So there are just a couple of advantages to using this kind of dynamic sizing formula. One is every time we have a profitable phase. So let's say from 1 crore our account moves up to 1.3 crores or 1 crore 30 lakhs. Then we are risking 1.3 lakhs per trade. We are increasing our size as our trading capital or our trading account is growing. We are not doing it just on the whims of fancies of what we think the market is doing or how good a trade looks. We are doing it in a very systematic manner. And the same thing is if we are in a drawdown and our account goes from 1 crore to 90 lakhs, we are risking 90,000 rupees per trade because we are trading badly or we are in a drawdown. And our strategy is going through a drawdown, the market is not conducive for us, so we are trading smaller. So, this is again another mechanical way to automatically regulate your position sizing based on a very simple formula, instead of second guessing and thinking what to do, what not to do. And, just doing it this way and concentrating on just repeating a process over and over again, whatever it may be. This doesn't matter which approach you're using, whether you're a intraday trader, whether you're a positional trader, whether you're an investor. You can regulate the percent number to whatever is your liking and risk profile, but this can be used across the board in whatever you're doing in the markets. So that is one advantage of doing this. So now we'll come to some trade examples, both long and short, of some trade examples which came to mind, and of recent trade examples. So this is an example of Adani Ports. I still remember for a very brief time the infra sector, which this is a part of according to NSE classification, was actually outperforming the Nifty a few months back. So Adani Ports, as you can see here, there was a big anchor column and a huge consolidation. This is in fact an ABC pattern, and then it gave a breakout right here. So we would have entered around here somewhere, and the exit was somewhere here in this column. This continued in that same column. So this was one profitable trade. This is a trade of a stock which came into the future space quite recently. PI Industries. It's part of the commodity sector. Again, as I mentioned earlier,
just 1 minute. Can you go back to that chart of Adani Port?
Sure. Yeah.
So because you had a fixed target, you could get out before that big crash happened. Does it mean that way?
Because I had because I had a 2:1, my target got hit somewhere around here in this column before this column reached its peak. So I was lucky enough to get the target before this fall.
Okay, fine.
But as you mentioned earlier, sir, it works both ways, and there have been stocks which just keep going after giving in the same column, or they will give a retracement and just keep going, and they could have been basically give you profits of 3 or 4 or 5 times to your risk reward. So that also happens.
Yeah, I know. Yeah.
Yeah. So you have to decide what your rules are and what you're comfortable with, and in case in fact if you're riding also, a risk reward ratio could be more superior. It's something I'm testing, but I don't have enough data as of now. So now we've come into PI Industries, where you can see there's a clear breakout above the 45-degree trend line.
Yeah.
So there will be so another point is there will be a lot of ABCs, but not necessarily always there'll be ABCs. These breakouts also, as some people know, will come in different shapes and forms. So you don't have it doesn't always have to be an ABC. Just to clarify. So PI Industries also, we see that we booked the profit around here somewhere where I marked the exit point. This was Hindalco, and as we all know that the metal sector had a big run over the last few months, and these stocks, the metal stocks, in fact, also are part of the commodity sector according to NSE, which was at the top of the sector matrix for quite long. In fact, it still is, if I'm not mistaken. So you can see here there was a huge anchor column and there's a massive consolidation, and then Hindalco broke out. Our entry was somewhere right here above this trend line, and Hindalco also gave us a nice trade. Next one is sale. This is actually a very, very attractive looking trade. There was a huge anchor column. In fact, there were multiple anchor columns, if you can see in the past, which never broke. And then there was a huge consolidation for some time, which broke out. And trust me, I thought this trade is going to go to the moon. And unfortunately, in a couple of days, the stop loss was hit. And I think in 3 or 4 days, this trade turned into a losing trade. And coming to our next example, this is Deepak Nitrate, which was one of the big trenders of the last year. So you can see a clear breakout over here on Deepak Nitrate above this trend line. In fact, this was one of the few trades which we got to exit in a few hours. So it was basically holding overnight, and the stock moved so fast that it gave a profit in a few hours. But that's why I remember this clearly. But of course, that doesn't always happen too often. More often than not, the stocks take time. Very few instances of the stock gives a profitable trade so fast. But this was one of them. So let's take some short examples. This is escorts. The auto sector was a huge underperformer for the last few months when the Nifty has been rallying. So the short trade came somewhere around here, and this absolutely looked like it's going to fall off a cliff. And I thought it's going to be a big trade, but within 2 days, this shot up and hit my stop loss, and this turned out to be a losing trade. So that was escorts. This was LIC Housing Finance. In fact, while submitting the presentation, this trade was still open at the time, so I don't have an exit slide to this. But I've taken the short trade somewhere here, and now I can tell you that this short also ended in a loss, and it gave a slight down move and then shot up very quickly and stopped us out. So this was another losing trade. This is L&T FH, where this was a breakdown. It was also a bearish ABC, and we shorted somewhere around here below this, right below the trend line. And it gave us a nice trade. We shorted somewhere here and we exited somewhere here. After it gave a slight down move, it gave a retracement, and again gave a follow through. So this was a nice short. So that was some examples. Now, so just coming, I just wanted to touch upon a little bit on trading psychology. And when I say mindset made me a profitable trader, I don't mean your normal cliched mindset of like, let your winners run and cut your losses and all. That is of course important and you should do that, but that's not what I mean by that. The quickest way to get to consistent profitability is through mindset and through following the same approach over and over again for a long period of time. That is in fact a very, very important point which a lot of people lose sight of. I lost sight of for a very long time, and I currently also see people jumping from system to system. But you have to cultivate the mindset of taking that one thing which suits you. It could be any approach. It could be intraday trading, it could be positional, it could be investing, it could be something in between. Whatever suits your approach, you need to take that and you need to trade it over a large sample size of trades, whether it's 100 trades, 200 trades, 500 trades, preferably even more. Because what happens when you trade one thing for long is it starts evolving because you see things by experiencing it more and more. You see things which you never saw before in that system and on the charts, and you're able to evolve it better. So, if I had to give advice to anyone starting out or somewhere in the middle of that journey, still looking for that consistency, is that make a mindset shift and make sure that you take first one approach and shed all other things and just take that one approach and try to trade it over and over again in a repetitive way. And I'm sure you'll start seeing a light at the end of the tunnel. So this is a very important point. And the earlier you get this, I'm sure you can cut your, for people who are finding the learning curve very steep, I'm sure if you do this, you can cut your learning curve faster than what some people have done and what I have done. So, and now coming to just some few points of trading psychology based on positional trading, and it's not just restricted to this one approach, which I have highlighted, but just, just positional trading as a whole. It requires, what I've noticed is it requires a massive amount of patience for trades to trigger. So there have been times where I have followed trades or looked for trades to trigger, and I've followed them for more than a month and a half sometimes before they finally trigger and break out and trigger and start doing their thing. So it takes time. You have to have patience. You have to just sometimes just sit and wait. Also, there are many days when there is absolutely nothing to do. So, like I said, there are many days when fresh trades may not trigger. And also the trades you have open currently, or it's since you're doing positional trading, end of day trading, if anything changes for you, whether it's trailing a stop loss, whether it's finding a new stock with a higher entry, it all happens at the end of the day when your software is updated and you do your analysis. So in the day, once in the morning, once you put your stop loss and target, there are many days when, like I said, there's nothing to do absolutely. You can, go for a run, go to the gym if you want, read a book, watch some Netflix if you have to, but just stay out of the way of your trades. Let your trades do their thing, and don't keep staring at the market all the time. It just stresses you out and it doesn't help move the market at all. I've tried it for a long time. It doesn't work. So trades also can sometimes take a few weeks to meet our targets. So once you get like that, if I'm not mistaken, the Wipro example which I shared earlier, it was a very slow trade. So if I'm not mistaken, if I remember correctly, it took me around 3 weeks to reach the target in that trade. And at that same time, since the other IT stocks, which was strong, did not give my setup, like Emphasis and Mindtree, for example, they were going up crazily day after day. And since I didn't have that in my setup, I could not take them. These are just some things which happen sometimes. You have to keep patience with your approach, and be rest assured that if you keep trading that same approach, even you will catch those Mindtrees and Emphasis which keep going up in a straight line in certain phases. But for that, you have to stick to the same thing. Uh, So, the main point I'm trying to make with all this is that in between all this waiting and patience and just talking trades and sitting through doing nothing, there can be a lot of fear of missing out and mind games. Fear of missing out because there may be days where your stocks are not doing anything, but the Nifty is being propelled up by just two or three stocks, and you're wondering, why my stock's not doing anything. But your stocks will also have their days, and sometimes it just will not happen on a trending day when the index is going up. And all these things affected me also at a point in time. But as time went by, I also understood they're very normal, and you have to just keep sticking to your process, keep sticking to your rules, and remind yourself anytime you feel like breaking your rules or going outside your system and trading something else, which is the flavor of the month, or just because some stocks are going up. You need to shut all this out, and you need to create actually a little bubble for yourself sometimes, and just focus on what you're doing and not let these mind games affect you, especially when it comes to trading futures, which is anyway a high risk game, and it can rack your nerves at times. So you need to keep your psychology straight and your mind very clear. And the last point I'd like to make is this is something again from my own perspective, so it may be painted by my own biases. But when it comes to TV exposure, I don't watch much TV at all during the market. In fact, I watch it maybe on budget days or on a monetary policy day or something like that. But otherwise, I don't really watch it. I just keep a track in the morning of the stocks which I'm holding, long or short, or the stocks which are a part of my watch list. Are any of those stocks going to announce earnings today, or are any of those stocks in the news today for good or bad reasons? That's all I try to keep a track of before the market. If I want to look at anything else or know what is happening, I prefer to do that later in the day, maybe after 3:30. And also coming to social media, there are a lot of good things about it and a lot of new things to learn, a lot of successful people to follow and to learn from in many ways. So social media can be a boon also. Like I've mentioned earlier, if it wasn't for Twitter, I wouldn't have found Noiseless charts and Definedge and TradePoint, which definitely had a huge difference on my trading and my life. But social media also has a very dark side to it if you don't regulate your exposure. Is that when you're struggling, when you're going through a drawdown, when your mindset is vulnerable, when you're not in the best frame of mind because of your trading account or trading results, social media can affect you in a negative way because you're seeing people posting profitable trades and supposedly they're making millions every month on Twitter, or at least it looks like that when you're down in the dumps. So you need to be very careful of this and regulate your exposure to these kind of things. And I know that one of my weaknesses is getting easily influenced by noise. So I know it's better for me to cut that noise off as much as possible when I'm trading because it has immensely helped me. So just be careful of these few points. And if you actually take uh, these few points and add them to your daily routine as a hygiene factor for your psychology, it will make a small difference, which will compound over time. So think about it, and that's my email address in case anyone wants to get in touch with me. That's my Twitter handle. I am not actually very active on Twitter. I do check it every now and then, but not very often. And yeah, that's it, sir. Thank you very much for having me. And that's the presentation.
Just a couple of questions. You said sometimes there is nothing to do. In your previous slide, you said that sometimes on some days there are nothing to do. That's fine. If you
Yeah.
have, let's say, a few positions and you are putting your key in your stop loss, then fine, you have nothing to do. But has it ever happened that you have no positions, you are waiting for some triggers? In those days, you definitely have a trigger to, I mean, what look out for, right?
Yeah, so you have there have been times when I've had no positions.
Yeah.
And I have triggers. I have a watch list where I'm expecting things to trigger. But I
Right.
mean, there are days when those triggers take I mean, there are times when those triggers take a couple of weeks or a few days, and there have been those times where there are absolutely no trades open, or not in the recent past because it's been a good market. But there definitely have been pockets where there is absolutely nothing open also. No trades
Right.
open.
And second question
So
is,
it does happen. And yeah.
yeah, second question is, of course, of late, most of the trades have been in the long side. But do you have a rule
Yeah.
where a lot of people have it like they will trade only something like 60% long, and I mean 60 to 40, and the rest they'll keep open to look out for any short trades. Even if everything is long, you'll go long, right?
Yeah. I don't look at it that way at all. I let the market tell me what to do, and in whatever order the trades trigger, whether it's a few longs trigger or a couple of shorts trigger, I just go with the flow. I don't have any rules like that. Uh, Generally, what happens is when it's a clear bull market like what's happening recently, or it's a clear market when it's in a downtrend, you will automatically get more of that direction. So I don't
Yeah.
try to make for that. But so I mean, as of now, I don't have any rules. But as time goes by, things evolve, and ideas could come that to how to regulate that. But as of now, I think it is simpler just to go with the flow of what a system is telling you to do.
Yeah, so I think this has been a fascinating journey, and I'm sure a lot of people who are still struggling with systems will get some feedback out of this, and how even after struggling for so long, finally you have reached your, of course, I will not call it a holy grail, but your favorite system or favorite trading style. That is what everyone looks for. Holy grail is something which will never be possible, but something which you are quite get used to, and then you're comfortable with trading it. So that is something which comes after a struggle. Your initial profit in those days was maybe your beginner's luck, right? When you started and you made a killing.
It was completely a beginner's luck and too many positions. And things are not that easy in the markets. You have to pay your dues. And like you said, the most important thing is it's not the system at all. It's not the entry exit. There are thousands of ways to do that. All of them work as long as you can consistently do it. But it's more important that what you yourself as an individual can consistently do. And to find that sweet spot, sometimes it takes this time. So that is the key, I feel.
So that brings us to an end to this session, and it was a lovely session. Thank you, Sahil, for accepting our invitation and giving your thoughts and your trading system, actually. So I hope people will learn, and someone will. I'm sure there will be a lot of people who will approach you to get more pointers. So I'm sure you will help them also.
Sure. Thank you so much for having me. It's been a complete pleasure, and again, a great honor to be invited on this platform. So thanks a lot for that.
Okay, thank you. Bye bye.